All right, guys, welcome back for another video. I know I promised to do a video on the Blackrock 2020 market outlook. And I just want to cover their broad 2020 outlook. I know they have some more specific research papers, but sometimes it's best to cover the broad topics just because those things that they post front and center are probably the most important things. And it's interesting that they posted volatility of U.S. real GDP and CPI. If you guys have been following my videos, I've been talking about debt to GDP, but I haven't talked about GDP in relation to CPI. And again, remember, this is volatility of these two. So this is the volatility of GDP compared to volatility of CPI. So not actual metric, just the volatility, obviously. But you can see here that GDP is increasing and decreasing at a faster rate than CPI is increasing and decreasing. And apparently to be totally honest, that's a metric that I don't really have my finger on. But, and I'm looking at this for the first time. So this is news to me. But if BlackRock's looking at that ratio and considering that, then I'm going to do that too and keep that in mind. So they basically describe COVID as the beginning of a new era, or excuse me, uh, the Great Moderation is over. The Great Moderation from the 80s until 2019, before the pandemic, was described as a period of stability and growth and inflation, demand-driven economy with a steadily growing supply. Described with borrowing binges, with collapsing spending, driving recessions, where the central banks could mitigate by either raising or cutting rates. And they believe that period's over. And you know what? I tend to agree with them. I think we are kind of across the event horizon, so to speak. So they go on to describe it as a regime shift. Basically, obviously the pandemic, increased volatility dramatically within the markets, and also created production constraints, or as people commonly refer to, supply chain issues. You know, spending and labor shortages. Everything changed during the lockdowns and that part of the economy. And of course, it's driving inflation. And then, of course, the record debt levels. Again, this is not news to anybody, but it is interesting that they put this front and center. So, you know, this is something I've talked about often, is that record debt levels on a sovereign level, not just sovereign, but sovereign and corporate combined, is going to increase volatility. Right? It's a little bit different than what people are tend to used to thinking, like, because they're generally used to thinking about uh, you know assets with higher market caps as having lower volatility, right? Which generally is true, right? If you have a higher market cap in an asset, that will dampen volatility. But you know, it, on a sovereign level, the larger the debt bubble grows, the more volatility is inherent in the system. And so again, BlackRock is bracing for volatility. Central banks are rushing to raise rates and contain inflation that's rooted in production constraints. They're not acknowledging the stark trade-off: crush economic growth or live with inflation. I think this is a really, it may seem like an obvious point, but I think there's a depth and meaning there that may not be, identifiable at first glance. One thing I would say is that, in the process of trying to contain inflation, central banks have raised the cost of capital to the point where they're trying to crush demand. But in the process of raising the cost of capital to try to crush demand, they're going to engineer a recession that'll lead to more layoffs and more economic disruption that will damage the supply chain further and ultimately lead to greater inflation on the back end, right? So it's like again, going back to being a different regime, right? They're engineering the same type of supply chain disruptions that led to the high inflation in the first place. Now, of course, the money printing led to high inflations, but the supply chain issues caused by the pandemic and the economic policies in the pandemic definitely contributed to higher prices. So, again, the Fed is basically, you know, driving all the way home with this interest rate policy, creating market volatility and shortening economic cycles. This is something I've also mentioned too, is that, as the debt burden grows, the credit cycles get shorter, right? The interventions become more and more common. Um, and that's something we can talk about later, but basically, you know, that, it's interesting that, Blackrock goes on here to mention that the macro backdrop is no longer conducive to a sustained bull market in both stocks and bonds. That's changes the baseline portfolio construction, because typically your portfolio construction generally would be 60% equities, 40% bonds, and those bet generally both went up at the same time. Maybe not directly. If one went down, then the other went up, and you could rebalance the portfolio. Well, again, that's old data. Those are old models that no longer works, right? Under the current climate, both equities and bonds are going down. And it's interesting that they mentioned that, living with inflation. Um, Again, this may seem like it's kind of designed like a marketing material, right? So it may seem overly simplistic in its presentation, but I think sometimes simplicity is elegance. And I would tend to consider anything that BlackRock is publishing like this to be of high value and highly valuable to pay attention to. And what's interesting is they mentioned that, living with inflation, people tend to have a mindset that, inflation is transitory because the central bank will fight it. Well, they're kind of saying here that, you know, policymakers won't be able to contain inflation, that inflation is part of, the current system we live in. And it's saying here that they're not buying government bonds, right? They remain overweight equities and underweight government bonds and long-term portfolios. So basically, what they're saying here is they're expecting investors to demand more compensation to hold long-term bonds in this new regime. So basically, what they're saying is they're expecting yields to rise, right? And yields can only rise so much before the government can afford to finance itself. So they're by de facto kind of implying that the Federal Reserve will create a yield curve control program. And now, who knows where that will be? But there's clearly some rate on different treasury maturities that, some yield that is unacceptably high, right? It'll cause government to not be able to finance itself. Now, this is interesting. So, positioning for net zero. This is so, even despite all the stuff we've been seeing about the energy crisis in Europe and how their ESG policy has led to, different uh, unsavory outcomes as far as, energy prices in the region. We still see BlackRock pushing ESG and positioning for net zero, and, you know, taking investments in net zero carbon emissions. And they think that's going to be a big thing. And you know what? To be totally honest with them, or with you guys, I actually personally agree with that, just from my experience in finance. And ESG may not be a productive allocation of capital, but there's definitely a lot of capital chasing it. Um, you know, it's again, it's not, it may not be the most productive allocation of capital, but there's a lot of capital there and a lot of capital moving in that place or in that market. Because generally people contribute capital to the things they believe in. It's kind of like back in European times, there were all these beautiful churches built, right? Just unbelievably beautiful churches because people tend to allocate capital towards their beliefs, right? And that wasn't necessarily a productive use of capital. And I think it's the same way with ESG, right? There's these people with a large amount of money who are willing to take um, a lessened rate of return to invest in something that they believe in personally. That kind of, that has a major tie into Ethereum. And I think Ethereum, one of its major marketing points, aside from the yield available after the merge hypothetically occurs is how environmentally friendly it is, and Ethereum, I believe, will be pitched to these ESG investors, and they'll just eat it up. Now, BlackRock concludes their piece by, you know, saying, ready to shift views, saying that, basically they're pro equities over the long term, but underweight in the short term. There's a lot of market uncertainty. And right here, they call out people buying the dips, right? Like buying risk asset dips isn't going to work. With the new regime of macro volatility, shorter credit cycles, and more volatile markets, they're going to take a more dynamic approach to portfolio positioning. And conviction is that portfolios will need to change more quickly. Now, it's interesting that they didn't mention Bitcoin, but as we both know, BlackRock just offered a Bitcoin spot ETF. This is interesting. So they have views on different asset classes here. If you go to this asset class view right here, they're negative on, well, that there's really not a lot of conviction right there, but of course they're long equities over the long term, but these aren't very high conviction views. In the short term, neutral, 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 or negative. Yeah, that is not. Maybe there's more on this side of the chart, but this is not really that valuable in my opinion. Um, Now it is interesting to consider. BlackRock just offered spot services to their institutional clients, so it's interesting to think about, when, you know, what kind of effect that will have on the market. I think that's one of those things. It's like one of those news pieces where it came out, people got bullish about it, and then forgot about it. But I think it's interesting to mark off exactly where in the chart that occurred. So August 11th, right here, BlackRock announced their spot Bitcoin offering to their clients, and that was a local top in the market right there. It pushed just above these highs right here, grabbed liquidity, and ran lower. That is pretty classic stuff right there. It happens all the time. Um, yeah, I mean, buy the rumor, sell the news, but on a fundamental level, right? If you know, one thing you'd want to think about, right, is if BlackRock is offering spot exposure to their clients and announcing it on the 11th of August, did they already have significant spot exposure before that? Probably, right? In order to offer spot exposure, they have to have spot exposure, right? They're selling it to their clients, essentially. Now, of course, they'll accumulate more because the operation will demand more Bitcoin as demand grows. But I've got to believe that they were a significant buyer here at this level. And, of course, you'll never know. No one is required to identify themselves when they step in and support. But if you could, it'd be interesting to see if if BlackRock was the buyer and support right here. And if that is the case, then you would expect them to defend that level. Now, one other important part to mention about just market dynamics in general is that the the market price of anything ultimately is determined by the marginal seller, and that means that the conviction of people selling at the margin, which means at the market price. So really, in a asset like Bitcoin with the supply structure that it has, say hypothetically that institutions want to buy as much Bitcoin as they can, right? Like BlackRock, right? They have tens of trillions of dollars, right? That way more money. I mean, it would take you 5% of the amount of money they have to buy up the entire Bitcoin market supply, circulating supply. So they're too big to get in, right? It's significant size. So they have to engineer liquidity to the downside to fill their positions. And, they don't have a sense of urgency, right? They don't need to push up price immediately because they have as much time as they can. As long as people are willing, as long as the marginal seller is willing to sell at the capitulation lows, they're they can accumulate as long as they want, right? At more favorable prices. Um, and really, I think that's what governs price, right? I mean, price will remain at these levels so long as people are willing to sell there. Once sellers are exhausted, then the market will go up to find liquidity at a higher price, where more people are willing to step in and act as sellers. Now, that view of the market is entirely contingent on viewing this as a capitulation low, right? So, um, I've shared a graph of Bitcoin net realized losses. There were more realized losses taken in the Bitcoin market at this very point in time, this June volume influx right here, starting here and going down to here. More realized losses were taken at this part in the market than any other time in Bitcoin's history. So you could also describe this as one of the biggest actually the biggest capitulation in Bitcoin's history. And with that in mind, you never want to be a seller to capitulation. Um, everybody does it, right? At least in my experience, that's one of those things that you got to learn the hard way. And once you do it once, you'll never do it again. And one reason being that if you're experiencing capitulation and you're part of the group that's capitulating, it's very difficult to identify that, especially the first time around, right? Because it feels terrible. Um, but of course, after your experience with that, and when it's the second time around or even the third time around, you'll be able to identify when it's happening, identify that feeling in yourself again, and hopefully you have a plan set out for that, to avoid capitulation. Because again, one of the worst experiences is selling at the lows and then watching Bitcoin rally parabolically after that point. Anyway, not financial advice. I hope you guys like this video. If you like this type of content, just make sure to like the video, subscribe to the channel. I'll catch you guys in the next upload.